Muchas gracias. A continuación, tengo el gusto de presentar nuestro segundo panel del día de hoy, titulado Fondos Generacionales, Implementación y Aspectos de Política. Presentaré entonces brevemente a nuestros dos expositores, el señor Octavio.
The assessment of at the Morningstar Company to identify the gaps and areas of opportunity of the Afores. And he has been a promoter of best investment practices and consensus among authorities and the Afores. Now, Mr. John Turner. John Turner is a director of Pension Policy Center. Previously, he worked in research offices of AARP, the Social Security Administration, the Department of Labor, and International Labor Organization in Geneva. He has published more than 200 articles related to pensions. He received an award from the Journal of Risk and Insurance to the best article of the year and of the American College of Employee Benefits Council twice to the best proposal to simplify the law. He was chosen by the Volunteers Growth Alliance organization that gathers more than 100,000 volunteers as a Volunteer of the Year for the training of regulators in Eastern Africa. He's graduated from University of Chicago. Without further, I'd like to thank our two speakers, and I'd like to invite Octavio to the podium. Thank you. Good morning. Thank you. We'll talk a little bit in depth about technical aspects that were followed in the specific case of Mexico in order to build the glide path. And I think it is worth to give you the context that it is about Mexico, because if you start building target date funds system, building the glide path will be different from what we did in Mexico. Basically because we were considering cohorts that have accumulated for a certain period, and you are transferring them to a new investment scheme. So all of that had to be taken into account in order to design the glide path. And I believe that was the biggest challenge in that stage. The first thing that we faced is that historically the retirement savings system had exposure to variable income, which were very low. CFORE, SB4, which was the most aggressive multi-fund at the time, had an exposure limit of 45% to variable income. Afores used close to 70% of that limit, so there were exposures of about 24%. So that in the design of a glide path, as we saw in the previous presentations, at the beginning of that path will have very high exposures to equity. That is the first challenge. And exposure ended at zero. The funds of those who were close to retirement could not invest in that. That was the main or first change that had to be introduced into designing our glide path. A fundamental part of the objective of the target dated fund was to increase the investment capacity and variable income of CFOs. Now, if we refer to the basic financial principles, if variable income or equity were not more profitable in the long term than debt, well, companies would not exist then. And it is that is the rationale. We could not think of 40 or 45 year funds for retirement that were not investing on equity, and that is basically that is the rationale behind. Now, in terms of the design, by introducing demographics, that's something that we've already said, but briefly now, during this morning and yesterday as well. But what's behind this is the theory of human capital. When we were young, all of us here, we were rich in terms of the future contributions that we were going to make to our retirement accounts, given the horizon ahead of us. And in that sense, our human capital, if we want to model it financially, is a bond. Basically, it is a bond that will have periodic payment of contributions or coupons over time. That is what our human capital is all about, the financial capital that we accumulate for the retirement period, that usually happens when we join labor force is very little. So this is how it works. We're rich in terms of future contributions, and we're poor in terms of cumulative financial balance. So I can take more risk with my little money that I have, and my future contributions will taper down in time. There are fewer and fewer coupons to collect as I get close to retirement, and that needs to be reflected by my glide path. When I'm at the beginning of the period, or my labor period, what I will be looking for is to increase the yield over the very little contributions that I've given, so that those contributions will grow as soon as possible and capitalize. As I get closer to retirement, will this pot, my human capital is turning into financial capital again, and then I need to remove volatility from it in order to get close to retirement age. Basically, that is the principle of the glide path design. Now, this doesn't mean that I will stop investing on equity, but there needs to be a turning point in which I need to continue to create income, even during the retirement stage. Now, what's behind all of this construction? There's a number of variables behind contribution, consumption, contribution density, savings, appetite for risk, life expectancy, volatility, and performance. Now, what are the ones having the largest impact on glide path is longevity, life expectancy. That is going to be a key factor in building the glide path. The level of contributions that curiously enough, when we designed this glide path in Mexico, the contribution was 6.5. Then, after a year, there was a pension reform that raised the contributions to 13%, I believe 15%. So more than double the contribution. And yield or performance and volatility of the markets. Each one of this is quite idiosyncratic to countries. So there's no silver bullet, so to speak, not even in the region. So this is something that is on a case-by-case basis. What happened in Mexico? This is the glide path design in Mexico. Mexico has a life expectancy which is low compared to developed countries, and that means we have more risk-based assets. As our life expectancy is low, that means that we can have less risk-based assets in the construction of the glide path. But the contribution density was a major problem in the individual accounts in Mexico. I don't really remember statistics, but when I was in CONSAR, I believe people used to contribute 6 out of 10, 6 out of 12 potential contributions. That is to say, half of the year they were contributing to the formal system, and half of the year they were not contributing to their pension systems. And that becomes a challenge. But that also has to be a part of the glide path. If they are going to contribute half of what they should, well, those contributions need to be exposed to a larger proportion to equity, to riskier assets, so they can grow more. On the one hand, life expectancy that is low allows you to run less risk, but the contribution density means no, you need to run risks anyhow. That is what we identified in Mexico, at least. Now, the contribution profile. In Mexico, unfortunately, and this is something that is not inherent to the pension system, but it's part of our Mexican economy, most of the members of pension systems will not have or experience actual growth in their funds. If they earn 5 minimum wages, they will probably earn 5 minimum wages at the end of their work life. This is how labor life happens in Mexico. When you have a path or when you have salary growth that is very stable or constant, that reduces the need of having high risk assets, because what I need to cover with a replacement rate is lower because it will not grow in time. The growth pattern and a reduction of ages close to retirement mean that we need to keep risky assets for a longer period of time. This is a wage pattern in a country like ours. This is showing growth during the work life, and then then it drops closer to retirement, as what Nick mentioned. In Mexico, we don't see that. In Mexico, it's constant. So what this means is that I'm going to contribute relatively constantly little during my work life. I will have low contribution densities. That means that I need to run more risks in my glide path in order to compensate for the lack of contributions. Be careful with this. This doesn't mean that we need to run more. You cannot compensate lack of contributions with more financial risk, but you need to consider those aspects in the construction of our glide path. The other one is yield or profitability and volatility. That depends on the investment regime or scheme. In Mexico, one important thing in building the glide path is that there's an investment limit in foreign instruments, close to 20%. So 80% of the assets must be invested in the local market. So when we start analyzing the local market, the local market has an attractive bond offering with significant spreads. Expected returns is significant. It's even internationally, this looks attractive. Today we have lots of assets coming from outside because Mexican debt is attractive, and so that had to be part of our glide path. So you have that market available for the Afores of investment grade and high yield, and that means that we can lower exposure to variable income. We must also introduce the variable income market, the local one. It is not the most liquid, so it compensates or it offsets due to the depth and the width of the debt market, and that also established the level of variable income assets in the glide path. Once we introduce everything, it's like a blender, right? Contributions, density, life expectancy, contribution density, as I said, and yields or returns. So what we need to do now from the point of view of demographics is to model our workers. So modeling a typical worker, no. 3, 5 different or typical workers. There's even an afforded that modeled using a stochastic model for all workers. It is a huge complexity. It's a great model, but it's not necessary to get to that level of granularity in order to get a good forecast for that glide path. What did we do? We modeled three typical workers. We did a stochastic simulation with contribution densities, with life expectancy, and the stochastic simulation about market returns. So you end up with a results distribution at the age of retirement, accumulated amount, and the cost of pensions at that time. The coefficient is the replacement rate, so you end up with a replacement rate distribution from those n results. Yeah, you need to make decisions based on those. So the chart that I mentioned in passing yesterday is that in the x-axis, where traditionally you find the risk, we need to consider the first percentile of that distribution of risk, and that means that shows what is the worst result that I obtained throughout the entire set of replacement rates, and I typify it. And the y-axis shows the median, the 50th percentile of that distribution. What is the median? What is the median distribution result for the replacement rate? What do we want to achieve? Is to achieve that median, to grow without increasing the worst result risk. So what we did, we broke it down. It says current CFORE in red, which were the results of the replacement rate with the multi-fund scheme. So what it was telling you, so with the current level, it started at 45% with variable income and a landing point of 0%. So what they were going to achieve was replacement rates in the worst case scenario of close to 20.7%. That would be the worst replacement rate scenario, and the median of almost 36%. That was the base scenario. What we had to look for with the glide path design was to improve this result. With the simple fact of removing the multi-funds, we improved the replacement rate from 20.7. It became 36.3 without modifying the investment limits, just because of the fact that it was a continuous investment, that it was that it didn't need to create any liquidity for these transfers, and that's why the replacement rate was better. So once we started from that model, the base model with the same investment limits, this is variable income, but we did it using the aggregate risky assets limits. So what we did was to increase the investment capacity in those kinds of asset classes, and we run the stochastic simulation. The first one had a limit of 45 with a landing point in 0. The second one, stochastic simulation went up to 50% of variable income with a landing point at 5%, and so on and so forth. And you get replacement rate distributions that are inherent to that kind of investment distribution. Each one, the median is higher than compared to the base scenario, but it keeps the risk level or lowers it. That's an acceptable result, and you can continue to explore. So in the chart, every time that we went up and to the left, those meant acceptable results, because it didn't mean more risk to the replacement rate scenario, and we were achieving the expected result, or the mathematical expectation about the replacement rate. So we ended up at 60% of variable income at the beginning of the glide path and a landing point of 15%. That result moved 20.9%, the first percentile, which was negligible as a variation, and that increased the replacement rate, the median, by 40.3% under those assumptions. So had we continued to optimize the variable income limit, if we had gone to 65%, the median would have grown to 41.6. However, the first percentile of risk would have grown to the right. So what did this happened in the model we ran at some point. Basically, what we were not getting was the limit had been larger, 40%, we would have been able to optimize all the way up to 70% of variable income. But with the investment regime conditions that were achievable, because the limit of 20% is a legal limit that cannot be changed by Congress, it was not part of the design mix that we were using for the simulation. So we stayed at the scenario in green, and that is what we use to model our glide path. All this construction, at the end of the day, what it brings or considers the demographics of the savings system, the life expectancy of Mexicans, and the potential or expected returns the Mexican contributor can have access to. Something important as well to mention about these forecasts or projections, when you are on the side of the Afores or the pension fund managers, you do this with capital market assumptions, future yields, if you wish, because as a manager, you need to provide your vision about the market. I believe the variable income will be this, the fixed income will be that. That is the core of the investment departments of the pension fund administrators, to have a view of the markets. When this was built, the regulator cannot have a market view. So what we did is that this construction or expected returns construction was done with historical returns of the last decade. I assume that these last 10 years will be good to predict this stochastic variation. It is a forecast or an assumption that is so good, it is as good as the one provided by the head of pension fund manager, but I do not have an economic view, and I need to consider historical information.
Given this, then, the glide path that we see here, these are the different age ranges, and these are the limits for variable income, and they have to build these projections within these restrictions, up to 80% and up to down to 15%. This is the range where they actually want to perform. Well, that's up to each of them with certain limitations that we're going to be looking at now. So once we finish the modeling of the limits of the variable income, the rest of the limits that we have in this investment regime, and my acknowledgements to the previous presenters. It was very diversified when I arrived, with many different types of or classes of assets, and this made the construction of the glide path very efficient. But the limits for the rest of the assets that were considered alternatives, the local rates and the commodities were very broad. So basically what we did is, instead of having these stages that we were managing historically, we smoothened them and we turned them into a curve, and they are aligned to a glide path model. So the starting point then was 95%. Up to 95% of the portfolio can be invested in risk assets, and the final point, the end point, 36%. So there we have a much more interesting risk than only variable income, because you can mix them with rates, because I don't think they are anyway risk assets, but literature does consider them as a risk or private or capital assets. And I think that well, they are available in the market, and these markets tend to be complex. We require specialists within the fund managers to manage commodities, and I believe that that is the main reason as to why we don't see commodities in these portfolios. So this is the game area. They have put together then the glide paths within this game area. And if we make an analogy here with soccer, they can play on the defense side, half of the pitch or half the field backwards, or they can use the whole field, or they can position the 3/4 of the field up. The decision of each of these fund managers or Afore will depended on their risk appetite, but it had to be within this frame. And this regulatory frame guaranteed that it already has important restrictions as to the decisions that they can make for each of the different assets. It also has important restriction because it's not easy to depict that in these graphs, but they did have important restrictions with regards to liquidity, also levels of leverage. It's a whole framework of risk measures, and the glide path for the Afore had to comply with them. If it didn't meet those limitations, it was not acceptable. So we had this, and each of them presented their own glide paths, complying with all the regulations. The evaluation and the back test was put together, making sure that they complied with all of the investment regime. And we said, this is the level of risk that the regulator feels comfortable with. So here we do have to add something for the Mexican system in particular. At least in all of the research that I carried out prior to the Target 8 Falls project, which for me began in the year 2008, and I was able to complete by the year 2019. So it's about 11 years of research around this topic. I never saw leveraged funds. I did see the use of derivatives for the hedging of currencies. And what we found in Mexico is that these funds were already leveraged. They were already leveraged with variable incomes, with an important amount in swaps. And all of those assets were assets that had to fall within here because those positions, these were long-term obligations. That meant that the members would have had important losses. So the mix had to fall within here. Maybe we can answer some questions right now at this point. Yes, I have a question which comes from before the definition of the glide path. In the case of the members that have a quite flat profile in terms of their income, which sounds something similar to what we have here in Chile, they have a similar profile. My intuition says that in those cases, the initial balance has more importance regarding the future human capital, and it would tend to decrease the amount of risk. Yet, in the case that you mentioned, you did it increasing the level of risk. Maybe you can explain that a little bit better? Yes, given that the first contributions become very important because those are the ones that are going to be invested for a longer period of time, what this told us is that we needed to make a higher level of risk with those first contributions that can support the volatility of the markets in order to increase the replacement rate. And that's why you cannot see variables in isolation. So we do have the constant income throughout life, and your reasoning is right. But in this mix, we need to consider low incomes, low contribution density, but also on top of that, these two elements, sorry, and the replacement rates are going to be very similar to the previous models if the level of risk was not increased at the beginning. So anyway, once we set this frame... Sorry, are there further questions? Yes, Elio, go ahead. Yes, thank you. Thank you, Octavio. Now, a question in line with the previous question by Ursula. You mentioned mention one additional variable, which is the density of the contribution, and the average that we have is normally 50%, 6 out of 12, just as you mentioned, or 45% in some cases. When you did the analysis, did you see that by age group, or did you only consider the full average? That piece of information is important. Well, workers were modeled. Workers were modeled by cohort, and that's how we analyze density. Now, between the different cohorts, there aren't that many differences. There are differences on the income profile. The density varies according to the income. Higher incomes, higher density, more stable jobs, and the other way around applies too. At least that's the case of Mexico. Mobility between the formal and informal sector usually takes place in the lower income levels, and those lower income levels represent about 80% of the members. So what we needed to do was to model for those workers, not for the workers in the other 20% who are doing so much better.
Gracias, Mark.
Their fund, I think up to about 30%, which of course is great in a bull market, but in a bear market that can create some issues because you might have negative equity. So, but it has happened. So it's the only instance I know of significant leverage in a fund.
Thank you.
Tenemos una pregunta.
Yes, we have another question from Eugenio. Go ahead, Eugenio. Okay, now it's working. You said that the Afores, the fund managers, had a certain room in order to design their own glide paths. Maybe you can elaborate a little, because if you don't provide a glide path, I don't really know how much leeway they truly have in order to propose something a little bit different. Well, let me see. Basically, it's in the mix or in the combination of the regulatory thresholds or the limitations regarding leveraging, for example. It's like the optimization of a portfolio in a classical model. You have these restrictions, and you need to optimize a portfolio within those limitations. Yet here, instead of only optimizing one point in time, you're continuously optimizing. Instead of it being discrete, it becomes a continuous function. That's the big difference, really. But it's not really that different to the Markowitz traditional model to optimizing portfolios within a given set of restrictions. Okay, so once that optimization was achieved, and one of the big premises for this transition is we have 10 Afores, 10 fund managers, and the big premise is we don't want to end up wanting all 10 doing the same thing. That's what the industry was saying. We agree with the model. We believe that it is the right place, having a system that should be managed like this, but we don't all 10 want to end up doing the same thing. So it's basically, you have to give me the opportunity of reflecting my investment philosophy within the model for me to be able to differentiate from the others. So that took us into not designing one unique glide path, which was one thing that was mentioned yesterday, not defining just one glide path, and rather saying within this set of restrictions that we have just seen, then you can optimize your glide path. Now, something that's very important to mention here, as it was mentioned yesterday too, when BlackRock goes to sell their life path funds, they have a filing with the SEC, and it's legally liable for complying with the investment strategy. And in the United States, we all know what that means. It can be a very serious problem if they don't comply. In the case of Nest or the master trustees in the UK, the board of trustees will make sure that that glide path or with that level of investment is met with. And this applies not only for Mexico, but for all the individual account systems, the way they're put together in Latin America. The closest to a board of trustees in these systems are supervisors or commissions. That's the closest to a board of trustees in the traditional way of looking at the pension fund systems, because AFPs, Afores, fund managers in general, are, let me pick my words right, they are motivated by the profits that they can provide to the shareholders. So, if a certain investment strategy is appropriate at some point in time to optimize the profit of their shareholders, because the Afores charge as per the balance, so they are linked to the growth of the fund, because the interest of the companies, not only in this market but in any other market, are more important than that of the individuals, or come first at least. So if you provide a glide path which is wonderful in terms of optimization and future return, but at the first market change, and it happened just when we began with this, we had the COVID, then you start shifting back and you change to the shorter term because you don't want the balance to drop and you don't want your fee to have a volatility. So basically we're lying to our workers. We're saying we're going to invest in the long term, but we're actually investing differently. So how was that solved, which is one of the issues with the highest level of complexity when this migration toward the TDS was presented? It's the follow-up error. We know it in the literature as the tracking error, really. Tracking error. He makes sure that each of the Afores is committed to their investment strategy, not trying to maximize short-term benefits that will not contribute towards maximizing the replacement rate. And this is a discussion that I've long had, especially when I was in the regulator in the regulating entity for 3 years with the managers of the Afores. Your view of the market and the rates right now on the short-term hedging and that will add anything to workers in 45 years is simply not true. I mean, there's no way for those 3 additional base points on a short-term strategy can make a difference in a worker's retirement. And probably you're not going to be doing that throughout those 45 years because you're going to be making mistakes. And in the average, you've really added nothing but transactional costs. So that is the big reflection behind this. That is to say, if you already have then your glide path investment strategy, because this is a topic that was very difficult to internalize, and it's difficult for some of them to still go there. This is not an academic, mathematic exercise that I do to provide to the regulator. No, there is the investment strategy, the long-term view of the company, and what we really believe that we can offer our customers. It's all in there. So if we're not going to manage that portfolio under that point of view, under that approach, we're either deceiving the clients or maybe we should just change the vision. Let me go back to the case of that Afore that was investing in 90 and 180 days. Don't tell me that you're going to have an exposure of 60% in variable income when we know that your way of looking at the markets is very short-term viewed. I mean, put short-term view in your glide path then. And it was so explicit, and then the clients wouldn't dare. So that's why they proposed something that really made sense for a pension exercise. So it's an exercise that is not only a mathematical exercise, but it's a transparency, probity exercise, both to the public but also to our clients. This is what we think that we can actually do in the long term. Ursula, you have a question? Yes, and closely related to what you're saying. Yesterday, we talked about the possibility of making these complex financial decisions. For me, this is a conflict, having competition according to different glide paths. I don't really know what you think. The possibility of people to being able to tell between what's being offered as a different glide path by each of the different fund managers. How have you seen that? Yes, I know what you mean. I understand. And I agree with you. But that's why when we launched this model with the TDFs, we changed the performance matrix to pension units. The large amount of the workers are not going to understand this and don't actually have to understand this. That is not, I mean, they don't have to be specialists in finance to be able to have a good retirement. But what a worker can have is how much will I have once I retire? That's what they need to understand. And the glide path has a way of translating that. It's implicit when building the glide path. You know, what is your income going to be when you retire? Now, the managers don't really like this because, again, this comes hand in hand with the story that we've gone through after 25 years in Mexico, that defined contributions have no liabilities. No, unlike the defined benefits. But I believe that that is one of the big lies. Of course, there are liabilities, not something that can be demanded legally speaking, but the liability does exist, and it is the worker's pension, isn't it? So what I'm trying to convey here, Ursula, is that there's no one easy way for the worker to decide on this. So you need to put this in different terms. We need to say, what is the income going to be at retirement with this type of glide path strategy or other strategy? And with the fund managers, what they don't want is they don't want to make an income promise, because in their view they are exposed to lawsuits for and they become legally liable. So there are ways of putting indicators so that you are not liable by making an income promise, but you do need to change the way of communicating to the members. Or maybe I can tell you that you can also reduce the decision margin that the workers can have. That's also valid. Mike, you have a question.
Choices, and only two choices. Either an asset owner or somebody in their place has oversight, or the regulator has responsibility for oversight of the glide paths. And therefore the regulator needs to be separate from government enough. Does that make sense? I'm trying to think of the... If we agree...
I'm not going to comment on the part that the regulator will have to be separated from the government, but indeed the regulator has to have oversight of the glide path in this type of models.
And therefore, if an investment manager blows up because something was wrong with the glide path, the regulator is liable, yeah?
Yeah.
Yeah.
So the main thing, and it was commented here with a person of a Chilean AFP. These managers, a forest AFP, they're not asset owners. Let that be. They are asset managers. The role of the asset owners is fulfilled by the regulators. Bueno, entonces, en cuanto a la metodología de error de
So
seguimiento,
regarding the
lo que hicimos es,
methodology
tenemos que
for
tener una
the
metodología que
tracking
capture
methodology,
bien
we need to have a
el-
methodology that captures the abiding by the glide path. And another one of the technical challenges is that normally the tracking errors methodologies say that we measure the performance of the portfolio against the performance of the glide path, and that's how we measure volatility. Yet, if we look at this with investment, we can see that it's not manageable. When the administrator moves away from the limit, they're not really going to know why, and they're not going to know how to come back to these borders. And when there is a sanction that is implied, we have to make sure that that measure is manageable by the administrators, by the manager. So we measure this exposed, that it's not subjected to risk management, and that lower volatility does not imply lower performance, and that it allows for the stress scenarios to abandon the calculation. That is to say, in abrupt market changes, they can move away from the glide path only for valuation. We re-evaluate the position, or the position has decreased quite a lot. It's not the right moment to go out to the market to do a rebalancing, and all of that needs to be considered.
There's one more question from the audience. A question about the Mexican case. I remember that in the past, 6 or 7 years ago, people in Mexico could only transfer from funds once a year. But with this ex post measurement, can companies continue to do advertising about shifting companies, even though they may not continue with their investment policies? Yes, the change. You can change to another manager with lower performance every year. But if you shift to a higher yield pension fund manager, you can do it twice a year, I think. And that's the key. What is the indicator to allow you to do the change? At the time, it was peso-based yields. With this one, this one is based on pension unit, what the glide path could give you. And I believe a couple of years ago they made a decision of going back to peso-based performance. So the member doesn't lose degrees of freedom, but is deciding among the different glide paths with a performance-based measure. Well, the tracking error, what factors will impact the tracking error? Because this is why we mentioned this. One is the asset class, or the asset allocation will account for 40 to 50% of the tracking error. And this means if in my glide path I say that I start at 60% with variable income and I end up in 15, and I end up in 0, that will have an impact to half of that tracking error. The other is the preference for certain factors on weighting factors, growth, value. Remember that when you it's not only just pesos according to asset class. I need to name it. Variable income will be represented by the S&P 500 in the US, IPC in Mexico. Bonds will be represented by the Mexican Bond Index. All of them developed by price vendors. It will not be an index that you just come up with and that you assess every day. It has to be an index published by a price vendor that needs to be public. So with that, you breathe live into the glide path. The glide path stops being a mathematical exercise and becomes a benchmark portfolio that you can check every day with a daily performance. So it becomes a benchmark because it also becomes the benchmark to be beaten, but by the manager, which is the difference compared to the multi-fund scheme. At least in Mexico, managers love to say that they are total performance funds, and that's very comfortable from the point of view of investment management, because so you're not committed to anything. You're optimizing returns. You're not committing to anything by saying that. So that's why total return funds are disappearing in the world, because dump money is it's gone. People do not believe in those promises. 5 minutes, Octavio. We have the preference for factors, and finally, the cash management, which was so important in the case of Mexico, given the fact that portfolios do have leverage levels. Those leveraging levels have certain margins in derivatives that international markets are paid in cash. So if you do not see that in the glide path, you will be deviating constantly because of the cash you need to create in order to meet those obligations. It is a very complete exercise. This is the math of how it's done, but this slide allows me to tell you that beyond a measure not only of the tracking error is also equivalent to value out risk as well. So the tracking error of 5% is equivalent to the value that the CIFORES had. So I'm not allowing you to take more risk compared to the one that I used to allow you to, and that was very important in the transition to guarantee the authorities that had to sign this to the CONSAR board and the workers. And finally, with all of this, at the time, the portfolios looked like this, with up to 40% risk assets. This is how the system started when everybody presented their glide paths with a tracking error of 5%. For what I was able to check before doing this presentation, this has not changed significantly. The type of portfolio shape hasn't changed. So hopefully in the coming years it will change a little bit, because thinking in the long term about pension funds only invested in debt, it's complex. It's difficult for them to beat annuities by just investing in debt. Thank you. Now, Professor John Turner. We're going to use this microphone for this session. If you could please turn it on.
to understand target date funds, I want to start by just considering the opposite approach. What would it be like if instead of having the risk decline over the lifetime of the person, the risk actually increased over the lifetime of the person? I'm not recommending this, but just to understand how things work. If the risk increased over time with the person's age, when they had the largest amount in their account, then they would have the most in equity assets. And so the opposite approach, having the risk increase over a person's lifetime, would result in a higher expected account balance than the target date funds, because when you have a small amount in the account, you would have low risk and low return. When you had a large amount in the account, you would have high risk and high return. So the target date funds cause people to have a lower account balance at retirement than if you took the opposite approach of having the highest risk at the end. Now, the reason why target date funds do the opposite is because of risk aversion, that people, when they are near retirement, they tend to be more risk averse. But that is not the case for everybody. Some people would be better off, a minority, but some people would be better off with the opposite approach, the highest risk in retirement. And the reason I start off with this point is that people differ. And when you have everybody who's retiring in 2040 in the same target date fund, that is basically assuming they're all the same. It assumes they all have the same risk tolerance, they have the same life expectancy remaining, the same amount of assets invested in other accounts. And so the point of my paper is that there's differences in people, and how can we improve target date funds so that they would be better aligned to the individual's needs. So the issue, I'm an economist, and so we would call this heterogeneity and risk aversion. That means that there's differences across people in the levels of risk aversion. This article by Kemka, published in 2020, find that the current target date funds are suboptimal due to, that is the less than the best approach, due to heterogeneity and risk aversion. Using simulations, they show that target date funds could be substantially improved in terms of expected utility of the participants if the funds were better aligned to participants' risk aversion levels. And this is why I asked Nicholas this morning about Japan and the United States. That shows that there's, because of heterogeneity and risk between Japan, where there's high risk aversion, and the United States, which on average there's lower risk aversion, the funds in Japan have lower risks than the funds in the United States. So I was thinking, well, take for example, women and men. It is well known that women, on average, not everybody, but women on average, have higher risk aversion than men. So instead of saying women and men in Japan and the United States, so if you think of women like Japan and men like the United States, you would put women in lower risk target date funds. And so I'm going to be investigating the idea to see how much sense it makes. Now, Nicholas said that in Japan, it wasn't just that they had lower risk aversion. They, related to that, they contribute more than people in the United States do. So the analogy is not perfect because women have lower risk aversion than men in the United States, in other countries, but they also have lower income, and so they are contributing less. So it becomes more complicated. It's not, women have higher risk aversion, lower income, and longer life expectancy. And you need to take into account all those if you're trying to figure out exactly how it should be. And I have to say, it's more complicated than I originally thought about it. And thanks to Nick, I understand it better. But so those are the issues that would be part of the consideration. So in my paper, I'm going to present 3 proposals to personalize target date funds for improving risk management by individual participants. The first section discusses heterogeneity and risk aversion across people. And the second, third, and fourth sections present the 3 proposals. And each proposal, subsequent proposal, addresses weaknesses of the first proposal. So I present one and then another one that goes further. Research has found that risk aversion is related to age, that's the basis for target date funds, income, wealth, education, race, and gender. Women tend to be more risk averse than men. High income, wealth, and education is associated with less risk aversion. Those who have a low level of trust in others and those without prior experience investing in equities are less likely to invest in equities. Participants with greater financial literacy are more likely to invest in equities. However, studies also generally find a considerable amount of unexplained heterogeneity and risk aversion, which is a key finding. And what that means is that we know all these factors affect risk aversion, but when you do an empirical study, they don't explain everything. There's a lot that's unexplained in risk aversion. So, just for example, although women tend to have higher risk aversion than men, that's not true for all women. Women with more education and wealth and financial literacy would have more willingness to invest in risk. If it's just as simple as we knew that women had less willingness to take risks than men, we would just have a target date fund for women. But it's more complicated because there's some women who are more willing to take risks than some men. There's an overlap, and so it makes it more difficult to understand what to do. So because of the heterogeneity and risk aversion, simply assuming that women should have lower risk target date funds than men would not be appropriate for many women. For some it would be, but for many it wouldn't be. And so there's a balance there in deciding what to do. And without pursuing that idea further, what I do in this paper is propose changes that would more directly deal with differences in risk aversion to help people be put into the funds that would be appropriate for them, their level. So Nicholas
John,
was saying...
John, we have a question from
sure.
here. Manuel, please.
Yes.
Hi, Professor, thank you. So in addition to having lower levels of risk aversion on average, women also exhibit higher life expectancies. So if you actually go with a lower risk target date fund for women, you would be kind of hurting them on the average, but it would be kind of a double whammy because of their higher life expectancy. So I just wanted to add that. Yeah.
No, that's a valid point. And a related point to that is that the way that target date funds are currently structured, they're based on the number of years you've lived, basically. A different approach would be basing them on the number of years you have left to live, which would be life expectancy. And there's an argument that that would be a better approach to take than the current approach. Exactly how it would be implemented, that would be another issue. But at least as a conceptual issue, that would be another approach. So Nicholas was saying that BlackRock, at least in some places, offers target date funds with 3 different levels of risk. And so one approach would be that you could just say, for every target date, we're going to have a default maybe, which would be the current risk, but you could opt into a higher or lower risk fund for that target date. And so, if people knew they were, if they understood their level of risk aversion, they say, I just don't want to put as much in equity as that fund, they would go into the low risk fund. And if you were a man who was really aggressive and said, I want to take a lot of risk, you go into the higher fund. And so that would be one approach. And people who understand it could do it currently. If you say, well, I'm going to retire in 2040, but I want to take on more risk, you would put yourself into the 2060 fund, because that would have more risk than the actual fund. So that's another option, is to allow people to pick a target date fund that does not correspond to when they're planning to retire.
Professor Mark, please.
Yeah, I'm slightly concerned that people's risk aversion, understanding of our own risk capacity is the important issue, and they don't understand their risk capacity. So the point of a TDF is their risk capacity at 65 is lower than at 25. Whatever their risk aversion, men are overconfident and so invest more riskily. That's not in their best interest. Women are possibly, or certainly in our case, lower income people who have got a high risk aversion. We have to give them more risk than maybe they feel comfortable with. They've got the capacity to take the risk, they just don't want to, but they need to take that risk. So it's really important. People's behavioral biases don't always act in their best interests. So the point of the manager is, or the target date fund manager, is to give them the risk that they can afford to take when they can afford to take it, irrespective of whether they want that risk or not.
Okay, I actually completely agree with that, and it's addressed to the next 2 proposals. No, it's perfect. You set it up. So the second proposal is to offer access to a robo-advisor. A robo-advisor is a computer program that provides financial advice. Financial advice tends to be expensive. You're having a one-on-one conversation with a highly trained financial professional, and that is inherently expensive to do. Robo-advisors are much, much cheaper in the way of providing advice. So in the United States, the financial advisor would typically charge 100 basis points, 1% of your assets. And a robo-advisor would charge something more like 20 basis points. So it's a much cheaper alternative. And the way that they work is that you fill out a questionnaire, And the questionnaire is trying to assess your capability of bearing risk. So it asks, what are your investments outside of your pension fund? And then also tries to assess your risk, giving you scenarios. How would you feel if the stock market went down 20%? How would you feel if the stock market went down 20%? And you might say, well, it wouldn't bother me, I'm young. Or you could say, I would be really upset about it. And so the robo-advisor would try to help you assess what your feeling is about risk, and then recommend you the target date fund that would be appropriate for you. So a robo-advisor said the advantage of economies of scale. That's one robo-advisor, which is one computer program, can advise thousands of clients, while the financial advisor only advises one client at a time. So you can have a robo-advisor offered at least as an option for people when they were enrolling in a target date fund, and say, we have a default target date fund, but you can use our robo-advisor. It'd be cheap to provide to people for a one-time purpose, and the robo-advisor will help you pick one of the three funds we're offering that would perhaps be more fitting your personal needs. And robo-advisors, when they're connected with employer-provided individual accounts, can use data the employers have on the employee, such as the income of the person, their sick leave, and family status. And this information might also help to personalize the recommendations. So in the United States, we do have robo-advisors. Betterment for Business is a robo-advisor. Employers can offer Betterment for Business as a retirement plan investment management option for their employees. Another one is called For Us All. It's a robo-advisor that provides investment management solutions, and it focuses on small and medium-sized employers who are offering defined contribution plans. Betterment for Business writes on its website, our intuitive platform helps employees get better insight into their financial lives. They can link outside accounts, get retirement advice, and take advantage of automated tax-smart strategies. For Us All, on its website, writes, eliminate the hassle and cost of managing a 401k with a fully automated plan that gives employees, speaking to employers, that gives employees access to the investments they want, funds, mutual funds, stocks, bonds, and even cryptocurrencies. And in the United States, that's an option for some people to do that.
Sorry, can I ask you something about it?
Yes.
Is there any robo-advisor already working coming from a regulator? From a regulator in any part of the world, like the pension provider, the pension regulator having a robo-advisor to help people to choose? Is there any around the world already working in that?
I can say there isn't in the United States, and around the world, I'm not aware of any.
Okay.
But I don't think there is.
Okay. No, because I see it as a way of also helping. For example, in the Superintendency of Pensions, we have a pension simulator. Yes. That it's from the regulator, and it helps people. Well, we hope it helps people to take better decisions during the accumulation phase. Yes. But this is something extra. Let's say it's another technological support that can be used for people to choose better what level of risk to take, for example. Yes. Okay. Thank you.
Robo-advisors are relatively new, I would say maybe for the past 10 years. and they're being more widely adopted as people are aware of them. And I think it's a really good option, not just for target date funds, but for helping anybody with their investments.
Yeah, my only concern it's about how you regulate, how you control the robo-advisor. That's why I was asking if any pension provider, a pension regulator has it. Because, I mean, the formula, let's say, within, it has to be public. I don't know. I mean, it's very important if it is administered by a pension regulator to be trustful, no?
So in the United States, robo-advisors are regulated by the Securities and Exchange Commission, which regulates all financial advice. So the advice the robo-advisors provide has the same legal requirements that the advice that a human advisor provides. So this is my...
sorry, I didn't see you. Mike, please. Another question.
Let me put this idea to you. The Chilean pension supervisor already has a robo-advisor called climate scientists. My sense is that Chile is more aware of climate change risk than most countries. Since the asset owners don't sort of exist, it'd be quite possible for the Chilean pension regulator to say, our risk tolerance in financial terms of climate risk is, we are more risk averse than financial markets say. So actually investment managers in your business plan, I'd like to see that, because there's nobody else who can say to the people managing the money. So I guess my suggestion is, there is a robo-advisor to the Chilean pensions regulator, and that's called the climate scientists.
Thank you. We take it, and we think it. Please.
Okay. So the first two proposals, the first one is the person just chooses on their own. The second one is that they get help with a robo-advisor, but they still may not really understand the consequences of their risk aversion. And if they were more financially sophisticated, they may say, well, I really think I should take more risk because I understand that I'll have a better retirement and I can tolerate the risk. And so the third proposal goes a step further, and it proposes that there be what we call informational interventions, which is at the time that the person is making the choice of their target date fund, they would have the option of having a class, or maybe an online class, that would explain about risk aversion and risk and the consequences of your choices. And so they would know not only, I feel like I'm risk averse, but they would also understand what that meant in terms of how much they would have in retirement. So that would be the third option for helping personalize. Now, all of these options have costs. So the question is, what about the costs? As I said, robo-advisors are relatively inexpensive, and for one-time only intervention, it would be quite inexpensive. And I think that, this also, you could have an informational intervention that could just be a computer program where the person interacts with the program and they explain, this is what you think, but this is what it means in terms of the outcomes for you. So the central point of my presentation is that a simple target date fund assumes everybody is the same. they have the same level of risk aversion and the same life expectancy and other factors. And the target date fund is a really big step forward from having everybody try to figure out their own investments and how that would change over time. So I'm not saying this, I'm saying target date funds are a really good idea, but they could be improved to try to make it better fit the needs of individuals. And I proposed 3 ways of doing that, and I think that these ideas would be an improvement, and that they could be done in a relatively inexpensive manner, so that it actually would be feasible to, to take these approaches. So anyway, that completes my presentation. If anyone wants to email me, I'd be happy to to answer emails. And there's more information about my work on Google. My publications are listed there, and also at the Pension Policy Center, there's more information about the type of work I do. Thank you.
I invite you to take your seat, and we have more time for 10 minutes for questions, both for Professor Turner and also for Octavio. So if you have any question, please raise your name. Mike?
Well, I guess it's more a challenge to that point about the regulator. So my question, in fact, for anybody in the room is, yes, we all agree regulators shouldn't have a market view because prices are efficient and everything works. But should, and I'm happy for anybody to have a go at this one, should financial regulators begin to have a view on climate risk not being in capital markets? Should that be a regulatory risk view? So not a market view, which we sort of should. So I ask that to anybody.
That's a whole different thing. A regulator, from my point of view, can have views on capital market assumptions, but on risks, of course, it can. Being climate risk, one of the major risks that you have to incorporate to regulation. In fact, in my stay in CONSAR, we incorporate the first regulation to force a forest to have ESG integration in their investment process. So, yes, regulators should have a view on that. I was referring in the glide path construction as how do you have a view about capital market assumptions? I don't think regulators are for that.
No, I agree with that. I mean, the position we're getting to in the UK is that the pensions regulator is actually worried about the NGFS climate scenarios, which is another regulator's worldview. So we're beginning to have pension funds who have a well-developed view of risk. The pensions regulator is sort of close to them, it gets it. The central bank is still probably in NGFS land. So I think one of the issues I'm always exploring the question is the evolving view of risk across regulators. I don't know if anybody's got comments on that.
Yeah, it's very close of what I asked yesterday. When it's the paradigm changing, or when you are prohibiting something instead of enforcing people to change the minds. But indeed, I agree, it is a challenge. No sé si hay más preguntas de la audiencia.
Are there any further questions from the audience related to this topic?
Sí, Octavio.
One thing that you have to recognize is that financial markets will be always one step ahead of regulators. There's more talent. There's more people. There's more talent. There's more money. The regulators, the best they can do is to keep up with the financial markets.
Ahí tenemos una pregunta de Eugenio Salvo. Eugenio.
¿Se escucha? Sí. I have a question for Professor Turner. I don't know if you saw yesterday maybe at the presentations of Minister of Labor and also of the Superintendent of Pensions. They showed this graph where they talked about how we had this problem of people switching funds a few years ago, which had a very large increase of people trying to time the market in the pension system here in Chile. And my concern with your proposal of having three different kind of target date funds with trying to personalize or tailor risk aversion for different kind of people is that we might end up with kind of the same problem of people trying to switch between different target date funds because, I don't know, maybe someone heard that my target date fund where I'm at is better or has a better fund return than another target date fund. So how do you I don't know, how can that risk be mitigated in a sense? So.
I'm sure there's some people who would be like that. In the United States, I know best, that's why I'm just giving this example. In the United States, there are some people, typically they're men, who are very aggressive in changing funds. And to deal with that specifically, there could be some rule, like it could be you could only change once a year your target date fund, and that would limit the effect of it, so people couldn't like try to time the things that were happening to get out just at the last moment or whatever. So there could be some regulations to try to limit that effect.
Gracias. Tenemos las dos últimas preguntas de Mark Fawcett y Rosario.
Last two questions, Mark Fawcett and Rosario from Uruguay.
I wanted to respond to that because, in the UK we don't have that culture, but you have seen it in Australia, and it appears to be a culture in Chile of people trying to time the market. So you have to build in some friction to the switching process. So I think limiting switches or limiting when you can do switches, like once a month, there's a switching day, building in some cost to switches. Somehow you've got to change the cultural mindset that this is potentially an advantage and is actually a disadvantage to that switching. Now, it's not a very liberal policy. It's more of a paternalistic policy. We're trying to protect you from yourselves. And that may be quite hard to adopt. But if you're going to optimize the investment approach, if you're going to try and take advantage of your liquid assets, for example, and just stop people getting bad outcomes because they're switching, you have to change the mindset, and you have to put in the barriers to easy switching.
Thank you. Rosario, por favor.
En realidad es una pregunta para Octavio.
Actually, it's a question for Octavio. How had you implemented this
error tracking?
The error tracking that you mentioned. From what I understood, and please correct me if I'm wrong, is that you ask the Afores, the administration or the fund managers, to evaluate the TDFs according to the policy that they said that each TDF was going to follow. But that's done by an individual evaluator hired by the Afore, and then it's sent to the regulator. That's the way it is, right? Okay, and if there's a theoretical portfolio that follows that policy, right? The glide path, which is a timeline, because maybe I didn't mention this, each generation is separated at some point within the glide path, and at that specific point there is an asset composition that can be represented by different weights, different indexes, and that composition can be evaluated, and a certain daily weight can be put to it, and that that's what they do. So on a daily basis, those AFORES send out those assessments, those evaluations, that composition, and the tracking error that needs to be measured on a daily basis by each AFORE. It is sent on a daily basis, and then the regulator already has the evaluation of the investment funds, and then we internally calculate that tracking error. Now, it's a challenge for each of these AFORES or fund managers, because the most complicated things are the front office. You need to have systems that calculate pre-trade and all of these limits, so that when you have an operation, you don't move away from the tracking error. And there are very few systems that are not prepared or that are well prepared for this, but they do exist.
Bueno, muchísimas gracias.
Well, thank you so very much.
Muchas gracias
I want to thank Professor Turner.
Octavio
We want
por
to
las
thank
excelentes
Professors Turner
presentaciones.
and Octavio
Ahora
for their
tengo dos
wonderful
avisos de utilidad
presentations.
pública.